So this is part number 35 of this multi-part video series for positional stock traders. This is an important video because in this video, I'm going to go back to the basics. I want to help you understand the filter better because I'm going to give you a additional filter, right? Let me explain what I mean by that. There is a direct correlation between risk and filters. So for example, if you look at the orange trading system that I have created, so yeah, this one. So you look at this orange trading system, this is a framework, right? So first three steps are filtering, shortlisting, and then selection. Selection is these five circles here. Filtering, shortlisting, selection. After selection, you go to position sizing, then you take the trade, execute the trade, manage the risk with a stop loss, and manage the trade. Okay, this is the process. How is risk management directly linked to filtering? Well, the more tight your filters are, the lesser is the risk involved in the situation. The more lenient your filters are, the more risk you are taking. So, for example, let's go to MarketSmith. So, let's go to our positional filter. Okay. So, this is the positional filter as of today 89 stocks. Now, as per regulations, I cannot show you the individual charts of these stocks because I'm not allowed to discuss individual stocks. But here is the filter which we have put. There are 89 stocks as of today. As of today means whenever I'm recording the video. Okay, so these are the filters. Relative strength more than or equal to 70. Institutional demand A or B. Group rank less than or equal to 100. Price more than or equal to 20. Average rupee volume more than 1 crore. Average daily volume more than 2 lakh shares traded. 200,000 shares traded. Price should be within 25% of 52-week high. Price should be above at least 25% from the 52-week low. Price should be above the 50-day. Price should be above the 200-day. And since we are taking positional trades on the weekly chart, we have to put fundamental filters. So at least double-digit sales growth quarterly and EPS at least 18% growth quarterly. Okay. Remember one thing. Weekly chart means positional trade. There is no swing trade on a weekly chart. Okay. Weekly chart means by default, I am referring to a positional trade. And remember in the previous video what I discussed. What is a positional trade? A trade that you take in a positional stock. What is a positional stock? A stock that meets minimum 7 out of 12 of our criteria. That's a positional stock. So remember, you can take a positional trade on the daily time frame chart as well as on the weekly time frame chart. On the daily time frame chart, you are getting a much lower buy point. On the weekly time frame chart, you have the clearly marked buying range or the pivot range, clearly marked selling range, and the clearly marked stop loss range. Okay, which you don't have on the daily chart, that we have to do on our own manually. So positional trade you can take on the weekly and the daily. Swing trade is something which is only for the daily time frame. What is the difference between swing and positional? Well, in swing we give less weightage to the fundamentals. Okay. How is this related to risk? Now, for example, here you see average daily volume is at least 200,000 shares or more. Now, what if I remove that filter? If I remove this filter, then it will show me a list of stocks which meet all the other criteria, but not the average daily volume criteria. Okay. So for this criteria, let's see how many stocks we are getting. We are getting 89 stocks, right? So let's remove this criteria. See, now we are getting 143. So how many additional stocks we are getting? I have this calculator here. So 143 minus 89. So 54 more stocks we were ignoring in the previous filter. Why were we ignoring them? Because they were having average daily volume of less than 200,000 shares traded per day. This is average daily volume, okay? Although we are trading the weekly time frame chart, but we are, for filtering purpose, we are using average daily volume. And this is something we have learned from whom? We have learned from Patrick Walker. Patrick Walker is a student of William O'Neill, long-time student of William O'Neill and a veteran trader with 40 years of experience in the US stock market. We are applying that concept here. Okay. So we are only looking at stocks which are having average daily volume of 200,000 shares or more. So let's go back to that filter. So we are ignoring those remaining 54 stocks greater than or equal to 200,000. I will save it and I will apply it. See, again, it comes back to 89. Now let me recreate this filter because I am interested in those remaining 54 stocks, because those 54 stocks, what's the problem with them? The problem with them is liquidity, right? So if I take those 54 stocks, am I increasing my risk or am I decreasing my risk? See, I have told you always that trading is all about risk management. This is a game of risk management and probabilities. So I need to understand what am I doing here. If I remove that filter, right, I am increasing my risk because I am buying stocks which are having low liquidity. Risk relative to the stocks that you see on this list, correct? So let me recreate that filter and I will show you how we can manage that risk. Okay. So let's recreate this filter. Let us give it a name, low liquidity. Okay, let's recreate that filter. So relative strength more than or equal to 70, right? Buyer demand AB. Then here the industry group rank less than or equal to 100. Everything remains the same. Current price more than or equal to 20 remains the same. Right? Average rupee volume more than 1 crore. Average daily volume I am putting less than 200,000, correct? Because in the previous filter we had 200,000 or more. Here we will put the remaining. So we should get 54 stocks. So less than 200,000. Price versus 52-week high is greater than or equal to minus 25. And price versus 52-week low greater than 25. Correct? Same filters, no changes. Price versus 50-day, the price should be above the 50-day and the 200-day, no changes. Sales should be double digits quarterly. Earnings should be more than or equal to 18%, no changes. Okay, so now you have this filter. No, only one change we have made, less than 200,000 shares traded. I will save this and I will apply this. How many should we get? 54, right? Let's see. You see 54. You got the point now? These are stocks which don't come in that list, because in that list you have 200,000 shares or more. In this list we have 54. Okay, less than 200,000 shares traded on average per day. So if we are working with this list, if we add this filter, then naturally we are increasing our risk, right? I told you that the more lenient your filters, the more risk there will be. Is this a lenient filter? Of course, because you are not demanding higher volume on these stocks. That is why your risk is high. Now tell me one thing, you are my student. Tell me, how do you control risk? There are multiple ways to control risk, right? Primarily three ways. Number one, you go in with a small position size. Number two, you keep a tight stop loss. Number three, you you go in with small position size and a tight stop loss. You do both. Okay. So these are the three ways to control risk. However, the point I want to convey in this video is, what if we could control the risk at the filter level itself? Okay. So if I am relaxing one filter, why can't I tighten up other filters to neutralize the risk? So for example, let's open this filter. Okay. See, I have given this average daily volume less than 200,000 shares. So which means I'm increasing risk. But to reduce risk, what do I have to do? I have to tighten the screws on some other filter, right? Now there are these are the things we cannot change. The remaining part, these are non-negotiable, right? This is also non-negotiable. We can't change this. This is something we can change. Why not, rather than more than or equal to 70, why not make it 80 or above? So now we are, since we have reduced the volume requirement, okay, since we have relaxed the volume requirement, we are tightening up the relative strength requirement. So what I am saying is, okay, boss, if the volume of the stock is low, then at least I need higher relative strength in the stock. There should be something which should go in my favor. Moreover, instead of less than or equal to 100, why not make it top 40? Remember what Patrick Walker has taught us? Stick to stocks with relative strength of 80 or more, and stocks with in the top 40 industry groups. Okay. So here I have increased risk by changing this filter, and here I have tightened up the filter. So I have reduced risk by tightening up these filters. So this will give us a very narrow list of stocks. So what this will do is, out of those 54, it will only look for, it will reject the stocks where the relative strength is between 70 and 80. Those stocks will be gone. It will also reject stocks where the industry group rank is between 40 and 60. So we are being very strict now, because the liquidity in these stocks is very low. So on one hand, we are increasing risk. On the other hand, we are reducing risk. So we are neutralizing the risk at the filter level itself, so that when we take the position size, we can be comfortable taking a normal position size. We don't have to go with a small position size. Okay. Now, if you are a conservative trader like me, you would still go with a smaller position size in spite of this being this strict with the filters. Okay. That choice is up to you. Position size is something which is a personal choice. Okay. So let's see what happens. Out of 54, how many are we getting? Okay. So I save this and I apply. See, only 6 stocks. Okay. So out of 54, these filters have rejected 48 stocks. Okay. Does that increase our risk or reduce our risk? Of course, that reduces our risk, because now we are not exposed to those 48 stocks, which could have meant we would have lost money in them because they don't meet our strict criteria. Maybe their industry group rank is more than 40, or maybe their relative strength is between 70 and 80, right? Volume, we know volume is low. So either one of those conditions was not satisfied in those 48 stocks. So obviously we are buying a stock with too much risk. Like, the volume also is less than 200,000 shares. Maybe the industry group rank is also more than 40. Maybe the relative strength is between 70 and 80. Too much risk to talk about. But here, these 6 stocks represent uh, good relative strength, very high, very good ranking industry group. Liquidity is low, fine, but the other criteria that we have, that is being met. So these 6 stocks are worth investigating further. But I would still be cautious. Even if I find a stock uh, out of this list, I would be cautious with the position size. I would wait for volume confirmation. I would be very careful. I would look at the daily, I would look at the weekly, and accordingly, I would take the trade. Okay. So this is an additional filter which I wanted to give you. You can use this filter directly, but what I want you to understand is the logic behind this filter. So you could choose to customize this filter if you want to. You don't have to, strictly follow what I have to give you. So for example, instead of Doing this, you can do this, right? So less than or equal to 100. So now to compensate for this filter, you have just increased the relative strength, but the industry group rank you have kept it the same. So now the result will be between 6 and 54 stocks, right? So the number that we get finally would be between 6 and 54 stocks. You see 41. Okay, so out of 54, 13 stocks are gone, which means is a lot of stocks with the industry group rank more than 40. So there is risk. Okay, so you could choose to customize this, but I would prefer that you stick to the best leading stocks from the leading industry groups with institutional demand. Is not a penny stock. Okay, price near 52-week high, comfortably above 52-week low, trading above the 50-day and the 200-day, and having some fundamental characteristics. In one single statement, I have described the stock, which is a low liquidity stock. So be careful with these stocks. There is still some risk, even though you have tightened up the screws. But you could name this, let's say, uh, LLS, low liquidity stocks, something like that. Or you could choose to outright reject this filter, just use the positional, the original evergreen filter. No need to do any changes for that. Okay, that's basic. What do you say? Classic or vintage William O'Neill filter. Okay, if William O'Neill were trading the Indian market, he would probably use this filter that I'm talking about. This filter is consistent with what he has written in his book. Okay, and some of these points are consistent with what you see on MarketSmith. MarketSmith also has a William O'Neill filter, the MarketSmith website in India. Okay, so I hope this video has been helpful to you. This was part number 35. I hope you are enjoying this series. A lot of my students have written to me. Some of them have called me saying that after going through this series, they are more inclined towards weekly chart trading. They are planning to altogether stop daily time frame trading. It's their choice. Okay, it's up to you. I personally am a very flexible trader. I take a swing trade on the daily time frame chart. I take a positional trade on the daily time frame chart. I take a positional trade on the weekly time frame chart. So I am very flexible in my approach. Okay, my approach changes tactically based on current market conditions. Okay, but I am a mix of all. I don't stick to one particular uh, trading style. See, the style is the same. The number of points in the base and all of that, the criteria remains the same. The only difference being, is it a swing stock or is it a positional stock, and on which time frame are you taking the trade, because your buy point and the pivot point is different. And I have spent a lot of time on this channel explaining the difference between the buy point and the pivot point. So if you go back to some of my older videos, you will understand the depth in which I have covered this material. Okay, this series is like a course in itself. Okay, if you watch this series a couple of times, you it's like you have a system now. Okay, at least this will save you a lot of headache that you have been experiencing till now in the market. This will keep you in the leading stocks from the leading industry groups. Okay, thank you so much.